Hi students, thanks for joining me. I'd like to continue our discussion on inventory cost flows using the example that we've been working on in the prior podcasts from Horngren's Accounting 10th edition using exercise 617 found on page 405. I'm not going to use the specifics of that, just the totals that we came up with when we did our inventory records. And I would like to compare those totals between each other, compare FIFO to LIFO and weighted average, and see what the results are on the financial statements of different varying cost flow techniques. And keep in mind that in our example, we were in a period of inflation. Unit costs were going up each time we purchased them. So, let's start. First, please notice the total goods available for sale will be the same regardless of which inventory method you use. This is tied to purchases, and purchases were the same. And it would be the same for an entity regardless of which method they chose to use. Purchases and beginning inventory added together give you total goods available, and they are what they are, and it will always be the same for the three methods. The cost flow then splits total goods available between ending inventory and cost of goods sold. You either sold it or it remains in your ending inventory. Let's look at FIFO now and the effects that it had on our numbers. Ending inventory under FIFO was greater than it was under either LIFO or weighted average. The first items in are the first items out, and in a period of inflation, the last items that you purchased would be remaining on your balance sheet because the first items were costed out. Since you're in a period of inflation, the more expensive items are remaining in your inventory account, and so when you look at your balance sheet, ending inventory is going to be greater under FIFO than LIFO or weighted average. LIFO will be the least, and weighted average will be something in between. Now let's look at cost of goods sold. Cost of goods sold will be lower. Remember, total available minus ending inventory will give you your cost of goods sold. So if you're subtracting a bigger number for ending inventory, cost of goods sold is going to have to be smaller. If cost of goods sold is smaller, net income is going to be greater when using FIFO compared to LIFO or weighted average, because cost of goods sold is shown on the income statement, and it's less for FIFO because it includes older items. It's more for LIFO because it's the last items that were purchased for a more expensive amount in a period of inflation. And again, weighted average always comes somewhere in between. So after examining this, I think it's fair to say that FIFO makes your ending inventory look higher, your cost of goods sold look lower, and your net income look higher. So it would make all ratios seem just a little more positive simply from picking the FIFO cost flow. Why then would anyone use LIFO or weighted average? Well, people who want net income and ending inventory to look strong will use FIFO, that's for sure. But if your principal reason for preparing financial statements is to report to the IRS, having net income be larger just means higher income taxes. And since you're not really using your financial statement to present information to outsiders other than the IRS, it's all right with you if your ratios look slightly less because of your inventory method. And LIFO would be a good choice for you. Some folks just like it to be somewhere in between, and it makes sense to do that for their type of inventory, and they use the weighted average method. There is a pronounced difference on financial statements depending on if you use FIFO, LIFO, or weighted average, and in periods of inflation, which we're usually in, FIFO wins for making you look fiscally healthier. That might not always be your objective. In periods of deflation, interesting enough, everything reverses, but there aren't too many periods of that. in our economy. So FIFO would win as a general rule in causing these effects, as long as it was a period of inflation. Thanks for joining me for these comparisons. It's a pleasure working with you today. Have a good rest of the day.